There are a number of things that we're going to do tonight. One of them is to talk about what's happening in the market, in the precious metals market. As I said, my name is Kerry Stevenson, but what I wanted to do is start off by saying that this educational series that ABC Bullion put together is for you, their clients, for people that they don't know already, and I'm passionate about education. I'm passionate about saying to people, don't go blindly into something that you don't understand, and I think it is absolutely brilliant. And Janie, thank you so much for putting these educational seminars on. They are terrific. And I think that what I'd like to say is, just if we have a look at this slide up here, I'd like to announce our partnership with ABC Bullion, because at Symposium, we're dedicated to educating people. We're dedicated to educating people about what's happening in resources, what's happening in the physical metals market, precious metals, etc. So we've got a calendar of events that are happening this year. Calendar of gold, specifically gold, silver events. So tonight we're talking about why the bull market's not over, and I'm delighted that so many of you here have managed to get through this disgusting weather that we've been having. I got soaked 3 times today. I think tonight's going to be very interesting. I, for one, am delighted. Jordan, I can't wait to hear what you've got to say. And then in July, we're going to be bringing an extra special presenter. I'm not going to tell you who it is. You're going to have to wait for that one. But it will be an international speaker who's going to come over in July and talk to us about what's happening globally in the market, what you should be looking out for, and that's going to be another one in the educational series. And we're going to finish off in 2013 with the Gold Symposium once again at Luna Park. And again, show of hands, who was at Luna Park last year? Not as good as how many people own gold bullion, so we'll have to change that. Luna Park is not just a theme park, it's actually where we have an incredible lineup of speakers in October this year. This will be the culmination of the educational series, and it is going to be talking about the gold market. I'm delighted that ABC Bullion are partnering with us with the Gold Symposium. That's a really great event. If you haven't been there, have a look at the Symposium website, symposium.net.au. We'll be putting up speakers and details on that website soon, and there'll be special offers for ABC Bullion clients as well. Now, the guys in the audience and ladies in the audience that know me well know that one of the things we like to do at Symposium, and ABC Bullion have come on to this, is we like to give things away, don't we, Janie? And you all think that probably you have to do something. What do? There's a feedback form, because it's really important for us to get some feedback from you about what worked for you tonight, what didn't. That's the feedback form. It's in your wonderful PAMP show bag that's here on your. If you haven't got one, you weren't early enough. You have to come early next time. If you fill this form in, we've got 3 of those to give away. We're giving these away tonight, Jane. Is that one for me? It is. Excellent. Love doing this. So we got those, but first of all, I'm going to wait for the last few people to take their seats, and then I'm going to tell you what's going to happen before I introduce Jordan, because it's a bit of fun. So if I can ask you to quickly take your seats, because I'm about to get people to do something. It's quite a full house tonight. Do I know? Do I know what's going to happen? No, the big monster isn't coming into the house. He's already here. So are we going to take a break at all? Or are we going to go straight through? Okay, so I would suggest that in order to win the silver bars, once Jordan finishes speaking and we start to take questions, I'll have somebody going around and collecting your feedback forms. Is that right, Hannah? So we'll collect all the feedback forms. We'll collect them in here. It's going to be easier. And then I'll draw. Actually, no, I'll get Janie to draw, because if I draw, they'll shoot me. They won't shoot you. So we'll draw the 3 10-ounce silver bars, which is very exciting. But in the meantime, underneath some seats here in the audience, 5 of you need to just feel under the seat. And there's a silver coin. Oh, that got them excited. Now you can stand up and look for it. And when you find a silver coin, now Tony Howland Rose, you can look under your seat. Goodness me. If you find one, you can screech out and say, oh, there's one. Have I got one? One, 2, 3. Goodness me, how many are there? 4? Oh, it's on the seat next door. That's cheating, but fair enough, it's empty. It's about the only... Pardon? I hope you haven't got... Did you get one as well? Fantastic. Well, as you leave, I'll be collecting those silver coins from you. No, I'm only kidding. Just kidding. I think a big thank you to Janie and ABC Bullion. Thank you, Janie. That's a great way to start. Absolutely wonderful. So, in the interest of time, in the interest of me getting off this stage, I'm going to, without further ado, introduce Janie Simpson, the Chief Executive of ABC Bullion and a passionate believer in education. Please welcome Janie Simpson.
Well, thank you, Kerry. It's always very entertaining and an absolute pleasure to have you as our MC at our events. And I would equally like to say that ABC are very passionate about our education, and we're very proud to have gold sponsored or been your gold sponsor of the Gold Symposium for the last few years. And it is with great pleasure that we announce tonight that we again in 2013 will be the gold sponsor again. So in becoming a gold sponsor, we're continuing our efforts to educate the general public on the importance of holding precious metals in their investment portfolios. We have a range of in-house programs also at ABC, boardroom sessions, and as Kerry said, we've got another seminar in July where we're bringing out an international speaker, which will be a lot of fun. We'll learn a lot from that, culminating with the Gold Symposium at Luna Park in October. So put that in your diaries, that's going to be a super event. It's also lovely to see here tonight our trading partners, Bullion Money, the gold company with their first gold product, Asset Line, a brand new company we've become involved with, and we're super excited about our custodian vaults being opened at the end of April. Now, as I mentioned before, education is very important to us at ABC Bullion. This is also why we were proud to announce tonight that a few months ago, our speaker tonight, Jordan Eliseo, became our in-house chief economist. Jordan not only researches our weekly market reports and quarterly directions reports, he does one-on-one consultations with clients in our showrooms. He meets regularly with fund managers, the media and other bullion traders, and is very connected in the financial market. Jordan's background after earning a degree majoring in banking and international finance has been in the banking and superannuation industry, working with companies such as Deutsche Bank, JP Morgan and AMP over 15 years in both Sydney and London. He definitely knows these industries, and Jordan has had an immense insight into how these multinational companies play in the correlating markets and why they continue to ignore precious metals as an investment alternative despite the potential they offer us as investors. On the side in the early 2000s, Jordan was one of the smart minds starting a successful investment fund capitalising on the mining boom and the rising precious metal prices. Tonight, it's my pleasure to introduce you to Jordan Eliseo to explain to us why the bull market in precious metals is not over. Thank you.
Thank you, Janie, for that incredibly warm introduction. It is, in fact, a really exciting time, and I think a very opportune time to be standing here before everybody tonight, talking about why the bull market in precious metals isn't over today, and indeed why we here at ABC Bullion believe that both gold and silver prices are likely to go significantly higher over the course of the next few years, and indeed well into the 2020s. Obviously, the last couple of days alone have been pretty volatile and pretty interesting. We've seen precious metal prices actually pull back a little bit. We've seen the Aussie stock market pull back below 5,000 points. And in the last hour, we just saw the Bank of Japan announce that they're going to start printing 84 trillion yen a year in the name of propping up the global economy. So with all that in mind, it's actually a perfect time to sit down and say, well, what are the fundamentals underpinning the economy today, and what are the fundamentals underpinning the precious metal market in particular, and why we think they're going to go so much higher? And there are a few topics that we're going to cover to help explain that story. First, we're going to start by looking at the key themes that are driving the global economy this decade, and indeed where the economy is 5 years on from the supposed end of the global financial crisis, or the GFC. Now, to those of you who were here in October of last year, that'll be a slightly updated version of what I presented at that time, but it'll obviously be new to a lot of other people that weren't there at last year's ABC seminar. We're then going to look a little bit at the physical market for gold itself and why gold is not just another commodity like iron ore or copper or wheat. A lot of commonly held misconceptions about that, including within the professional funds management industry. It used to shock me the amount of times people just didn't actually understand the physical market for gold at all. So I'm going to clear up some of the more popularly held misconceptions around that this evening. That's going to segue nicely into why gold is still a monetary asset today. And then finally, I'm going to look at the nature of asset bubbles themselves. I've been fortunate to have quite a bit of experience seeing those firsthand, not just in the gold market, but with equities back in 2000 with the NASDAQ boom, and of course with the US housing market as well. And then we're going to talk a little bit about what to do next, what everyone can do here today, after tonight, to best capitalise on the opportunity that precious metals provide and to make sure their investment portfolios are well structured for what's going to be a pretty difficult time ahead. Now, before I do that, it is actually to keep our friends in Canberra happy, we must specify that tonight is an educational session only. So I'm going to walk in front of this so none of you have got a chance to read it. But basically what it says, there is a slightly serious aspect to it, which is that tonight is educational in nature only. It is not personal financial advice. So please don't all go and act purely off what you're going to hear here this evening. With that, I'm going to get into the presentation proper by starting to look at the three key themes that are going to dictate our global economic activity over the next decade and beyond. And those three are the amount of debt that we as a society owe, the role of the ageing population, and the role of the government itself in our economy today. The majority of the information that I'm going to present this evening is going to focus on the United States, and there are a number of reasons for that. The first is that the US is still by far the biggest player in the global economy. They account for roughly 1/4 of total global economic activity. So obviously anything that happens in the US is going to have a cascading effect into Europe, into Japan, and into Australia. The quality of information that we can get from the US going back well over 100 years is far superior to that we can get from other countries. So it helps to obviously use a larger pool of data when analysing what's really driving the markets. And last but by no means least, the US is a great proxy for what is going on all over the developed world. So the problems of too much debt, the ageing population, and really too much interference by government in our markets are affecting all of those nations as well. So understanding what the drivers of the US economy are going to be helps us understand really what is happening in Western Europe, in Japan, and to some extent even here in Australia. And let's start by looking at the debt. And what this chart shows is the aggregate amount of debt that we as a society, at all sectors, individuals, businesses, and government, owe relative to the amount of output that we're generating at any point in time going all the way back to the 1870s. Now, first and foremost, what I want to clarify is that debt in and of itself is not a bad thing. If it is used to invest productively so that one can then sell goods or sell services and generate income, then debt is self-serving and there's nothing wrong with utilising it to enhance your wealth. The problem is when we as a society simply go into too much debt and spend the money without worrying about investing it productively and being able to earn income with it, we end up with these absolutely gross imbalances, which this chart highlights pretty clearly. And as you can see, in the last 140 years, there have been two major periods where, as a society, we clearly have gone too far, we've borrowed too much money, and we end up in a very difficult financial spot. And as you can see, the very first of those was back in the late 1920s and the early 1930s, which is the period that we all know now of as the Great Depression. A period where stock prices fell well over 80%, a period where unemployment went above 25%, a period basically where the majority of people out there who didn't protect their wealth with things like precious metals saw their standards of living fall significantly and a large portion of their wealth evaporate. The sort of thing that we most definitely don't want to have happen to us. The second period of exceptional debt build-up and imbalances is very clearly the one that we are living in today, which, as you can see, we have been building almost uninterruptedly since the 1960s and in particular the 1970s. What this chart, or a chart like this, should help make pretty clear to everyone is that the GFC, it wasn't caused just by a couple of bad policies by the Bush administration or a couple of greedy bankers working for Bear Stearns or even a couple of million poorer Americans who borrowed money to buy houses that they could realistically never afford. All of those things were merely the straw that broke the camel's back. The reason the GFC occurred was because as an entire society, for 4 decades in a row, we spent too much money, we borrowed too much money, and unfortunately, now the time has come that we're going to have to start paying it back. And really, there's no way around that without our standards of living falling in some way. Now, there are 3 pretty key differences between the challenges that society faced back in the 1930s and that which led to the Great Depression, and the challenges that we face today. And unfortunately, all 3 of them make the issues even more significant. The first of those we can tell very clearly just by looking at this chart here, and that is that the amount that we owe relative to what we're producing is even greater than what happened then. So the size of the imbalances in our economy are even more significant. But the second and third one are even more important, and that is the role of the ageing population and the role of government itself in our society. Now, 2.33 is the number of children that every couple in a society would need to have in order for the population to remain stable. And there's not one country in the Western world that comes anywhere near having that many children. The US, ironically enough, comes around about at the top of the pile. They're having roughly 2 children. In Australia and in the UK, it's closer to 1.8, 1.9. In countries like Germany, Italy, Japan, the number is well below 1.5. This is going to lead to very, very serious problems that are starting now and that are only going to get worse going forward. Because not only are we not having enough babies, due to advances in medical technology and just our general standards of living, we're living a lot longer as well. So we're going to have less people that are going into the workforce and paying taxes, and far more people who are staying around withdrawing pensions, withdrawing social welfare, and ultimately draining money from the government. This slide here pretty neatly captures the scale of the problem that we face. Back in the 1950s, there were 16 workers for every 1 person who had retired and was taking some kind of pension payment or benefit from the government. So if you imagine at the end of the week, grandma or grandpa needed $100 to be kept in the lifestyle they'd become accustomed to, then 16 workers needed to pass their hat around and put $5 each plus change into the hat, and grandma or grandpa was looked after. And of course, back then they were falling off their perch in the late 60s. There's no real technical term for that. Wind the clock forward to today, and there's only 3.3 workers for every 1 retiree. And of course, those retirees are going to live much longer now. So at the end of every week, every single worker is now having to find more than $30 a week just to keep the social security system going as it stands today. And it's going to get significantly worse because in the future, because we're not having enough babies, there's only going to be 2 workers for every 1 beneficiary. This is going to impact us drastically in 2 fashions. One, it's going to reduce the amount of goods and services that we can produce because there's going to be less workers, whilst at the same time, it's going to lead to an absolute explosion in government spending on things like Social Security, Medicare, and Medicaid. And we can have a look at roughly what these numbers are going to be. McKinsey Global Research did a very interesting paper highlighting the impact of the ageing population in terms of the amount of growth we will not generate going forward. And from 2010 to 2034, they modelled that if the US was going to grow at the same rate it had historically, i.e. if the ageing population wasn't going to have any impacts, then growth would come to roughly $51 trillion, additional growth. But because of the ageing population, the number's likely to be closer to 32 trillion. That difference is that's larger than 1 entire year of economic output in the US. And the scale of the problem is more significant in Japan, the UK, Italy, etc., etc. So at a time when we need to generate wealth more than ever before because of this incredible debt burden that we've already got, we're going to find it harder than we ever have because of the ageing population. And the flip side of it is that government spending is going to absolutely explode. This chart here is based on the US government's own projections of what's going to happen from 2007 to 2032. They predict in their own typically optimistic view that GDP in the US is going to grow by 71%. But Social Security Medicare and Medicaid are going to grow by between 2 and 3 times that number. And these are not small items on Washington's balance sheet. These items alone, along with other non-discretionary spending items, plus interest on the national debt, account for more than every single tax dollar that the US government currently takes in. So there is absolutely no way they can sustain this kind of thing without drastically raising taxes, which doesn't win you any votes, or drastically cutting the amount of money that they're going to spend on the ageing population, which also doesn't win you any votes. And that ultimately leads to the biggest difference between the problems that we faced in the Great Depression, which obviously led to a huge market collapse, and the problems that we face today. And that's the role of the government itself. Now, back in the 1920s and 1930s, when the Great Depression occurred, the size of the government relative to the overall economy was absolutely minuscule, absolutely non-existent relative to what we all take for granted today. This chart shows the size of state and federal spending put together as a percentage of overall economic output. And you can see two very obvious spikes during World War I and World War II. But in the late 1920s and early 1930s, government spending was only 10 to 15% of the overall economy. So it's quite understandable why back then, when the Great Depression hit, some of the economic minds of the time and politicians of the time said, well, why don't we harness the power of government to try and save us from this very difficult financial situation we're in? Let's increase the role of the government. Let's start some huge spending plans, build the Hoover Dam, build an interstate system in the 50s, etc. And that will give people jobs, and that'll help promote employment, and it'll help us get back on our feet. Now, obviously, people of a more free market tilt will argue that that should never have been done. People of a more socialist tilt will argue that it was a good idea. That's not really the important point. The important point to understand is that back in the 20s and 30s, we can understand why they actually tried to do that. Because at that time, government was such a small player in our society. But wind the clock forward to where we are today, and government spending, at least in the US already, and it's higher in countries like France, government spending is already 50% of the economy. It's already $1 out of every 2 that gets spent. How much bigger do we want government to get if we're, as a way of supposedly solving the economic problems that we have? As I say, this is not me making an argument for small government or big government. It's just realising and acknowledging the reality that government is already by far the biggest player in our society, and bigger government is not going to be any solution to the problems that we face. For anyone that thinks it is, read your history books on Russia, read your history books on Cuba, read your history books on Venezuela or Zimbabwe. Government getting bigger than 50% of the economy is the road to ruin, not a road to prosperity in the future. And the other problem that too much government has, is that they also have a huge debt burden themselves. So all that money that we owed back in the Great Depression was purely as a result of excess borrowing and excess spending by individuals like myself and by businesses. But due to 40 years of overspending, the federal government in the US, and indeed in most of Western Europe and certainly in Japan, also faces these incredible debt burden of itself. This chart here shows US government spending, which is that dark blue outlays line, as a percentage of GDP, and revenues, or the amount of money that they've taken in tax as a percentage of GDP, every year going back to 1971. Ironically, the year that Nixon closed the gold window. And as you can see, with a slight interruption during the Clinton administration, they have been spending more money than they take in every single year for the past 40 years. So they've constantly been going further into debt on our behalf. Ultimately, that's how you win elections, right, guys? You say, I'll spend more on you than I'm going to take from you in taxes. If they didn't do that, none of us would vote for them. And the reality is that despite what the GFC taught us, despite the GFC very clearly saying this is the end, we cannot keep going further into debt, government has not got the memo. And in fact, they're starting to behave even more irresponsibly, which you can see by this absolute explosion in spending relative to the amount that they're actually taking in tax revenue, which has occurred over the last 5 years. And what's even more alarming when you look at that chart is, according to their own projections, they plan on spending more money each and every single year into the future. They plan on going further into debt each and every single year into the future. they have no plan, despite what you might hear. This is their own numbers. They have no plan to ever cut spending and no plan to ever stop going further into debt, and that's debt that we're going to have to repay as taxpayers. And in the last 5 years, we've seen them come up with all kinds of names of sophisticated or supposedly sophisticated policies which are meant to be for our benefit. We've had TARP, we've had TALP, we've had TALF, we've had HAMP, we've had OMT. In Australia, we've got a CLF. In Europe, we've had QEs 1s, 2s, 3s and 4s. A literal alphabet soup of supposed bailout plans that are going to set the economy right and make everything wonderful again. And they tell us that it's far too complex for us to understand. But the reality is, it's very easy to understand. The only way they can do this is by continuing to print money. That's what they've been doing for the last 5 years. That is what they're going to keep doing. That's why Japan just announced that they're going to start printing $84 trillion a year. And I want to show you guys, 84 trillion yen, I apologise. I want to show you guys a quick video which I think really sums up what's going on at the heart of government and with mainstream economists and central bankers. It goes for a couple of minutes, and I think you guys will find it quite useful.
Thank you very much for your time tonight.
It's my great pleasure to be with you. Good
Now,
evening.
you're an economist working in the banking sector, yeah?
I am. Should I get a lawyer? I think I'm entitled to legal representation if we're going to discuss my
No,
work.
this is just a few simple questions. Don't
Simple
worry.
questions?
Yeah.
How simple?
Well, they're theoretical.
Theoretical. I can
Yeah.
deal, okay, we can deal with that. I
Yeah.
mean, don't hold me to the answers, but...
Why not?
Well, because I'm an economist and I can think of a different set of circumstances under which my responses might vary somewhat.
And everything's connected to everything else, isn't it?
In economics, I'm afraid that is the global fear right at the moment, yes.
Now, right, there's a lot of uncertainty in world economics, isn't there?
There is a great deal of uncertainty and a lack of confidence.
Yeah,
yes.
and there's a lot of talk of quantitative easing.
Quantitative
that's a term
easing,
we hear
yes.
all the time.
That's a term you hear a lot at the moment, yes.
Yeah, what exactly is quantitative easing?
Well, I can answer this because actually we're advising a couple of governments about this right at the moment.
And what are you saying to them?
Well, perhaps I should just take you through what we're telling them to do.
Yeah, sure.
I mean, I
great.
won't go into a lot of detail,
No,
that'll
that's
be
good.
indiscreet, but this will give you an idea of how quantitative
Off you
easing
go.
works.
Yep.
Take printer out of box and place on table with the out tray facing the window.
The out tray facing the window.
That's right. Load paper into the paper receptacle and place currency on glass tray F.
Right,
Check alignment by printing out a test page.
right.
Go into copy settings and select double-sided and the number of copies you require.
How many would you suggest?
In the case of one of our clients, it's 80 billion, 120 billion in the case of another client, and one client wants 1 trillion of these things.
Can you get printers to do that?
No, you can't. You're going to need a bank of them. I mean, it's a
You need some
multi-printer
big
job.
ones, wouldn't
Yeah,
you?
big industrial strength.
Yeah.
Yeah. Big like a Bofors gun, all facing
Yeah.
the window.
Yeah.
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 Once you've ascertained that you have the alignment correct,
Yeah.
you alert the banking sector, open the window and press copy.
And stand well back.
Yes, you've got to stand well back because they can create a bit of a vacuum while reaching cruising height.
Whereabouts?
In the super fund industry very often.
And you'd have to consider the wind direction too,
Oh
wouldn't
yeah,
you?
you don't want to be doing this upwind.
No, because you get covered in pretend money, couldn't you?
Covered in what?
Pretend money.
No, this is not pretend money. This is real currency we're creating.
But aren't you just printing it off? I mean, these are photocopies, aren't they?
Excuse me. Dave, this is not going to work. Because I've just explained it to a bloke and he saw through it straight away. Are you in banking?
No.
No, he's not even in the banking racket. Okay, I'll try that.
Try what?
Have you ever heard of Rumpelstiltskin?
No?
Good. Now we're getting somewhere. Pull up a chair. I'll tell you a tale.
Look, it's obviously a bit of a light-hearted look, but it does carry a very serious message, guys. Every single one of us in the room today, or at least the large portion I'm sure, had to get up and go to work today to earn money. We had to get up and produce so that we could be paid something that we could then use to go and buy the things that we need. The concept or the idea that a central banker can sit behind a computer and use artificial entries to create paper money out of thin air, and that money will have the same value as the dollars that we're earning going to work, is just foolish. It's been tried thousands of times throughout history, and it has never worked. Common sense tells us that it won't work. And 5 years on from the GFC, our real economy continues to deteriorate because we are trying, quite frankly, foolish things to try and deal with the problems that we're facing. 5 years ago, in the United States, the US government was running an annual deficit of $160 billion. When Obama got elected, one of the things that he said was that that was irresponsible and he was going to halve it. Instead, he's multiplied it by a factor of 7, so that we now run $1 trillion deficits every year. Total government debt has exploded to $16.7 trillion in the last 5 years. That's a number that's so big it means nothing to any of us. But what it does mean for average Joe taxpayer over in the US is that each and every single taxpayer in the US today owes nearly $150,000 to Washington on behalf of the debt that's been racked up in their name. That's gone up by over $50,000 in the last 5 years. The real unemployment rate has gone to nearly 14%. Median family incomes, even for those people who have been lucky enough to keep their jobs, has dropped to only $50,000 a year, while the price of gas, due to all this money that's being printed, has gone up by nearly 40%, such that it's about $3.70 a gallon. This is not the sign of an economy that's recovering. This is a sign of an economy that continues to deteriorate because we have too much debt in the system and we're trying to cure a problem with more debt and with printed money. There's a few charts we can look at which will also help show what's really going on out there. In the last 5 years, this is the number of people that have lost their jobs versus the number of people that have needed to go on food stamps and disability. Nearly 5 million people are now out of work relative to when the GFC started, whilst over 21 million people have had to go on food stamps. Such that in America right now, nearly 50 million people, nearly 1 in 6 Americans, currently requires assistance every single month just to put food on the table. And we're being told that our economies are recovering and it's time to get bullish again. This is the labour force participation rate. It measures the number of people either actively engaged in the workforce or those people who are looking for a job. And as you can see, the GFC is this period in light blue here at the end. It has been plummeting since the onset of the GFC. People are so fed up looking for work that they can't find that they've just flat out given up looking. What happens when they give up is that the government no longer includes them in the unemployment calculation. They're still most definitely not paying taxes. They're still entitled to receive benefits potentially. But the government says, well, you're not in the labour force anymore, so you don't show up in the unemployment stats. So when Obama or when a politician comes out and says, oh, US unemployment is improving, it's only 7.7% now, the reality is it would be well over 10% if the labour force participation rate hadn't changed. The economists at your super funds, they know this, they just don't tell you. Unemployment in Europe, this is youth unemployment. Janie touched on it briefly in her opening, that just yesterday, the total European unemployment figure is at a record high of 12%. Youth unemployment, those people that are actually going to have to pay taxes to support the social welfare system as it stands, is over 25%. In places like Spain and in Greece, it is over 50 or 60% today. This is the kind of stuff that, if anything, tends to lead to pretty serious social unrest. It's not the kind of thing that leads to serious economic prosperity. This is last slide I want to show you guys is import and export activity out of Long Beach, California and Seattle. It shows quite clearly that the number of ships rocking up to drop stuff off and pick stuff up is falling. It's been falling since the middle of 2010. If our real economy was improving, why would less ships be coming to port, picking up less stuff to export overseas and dropping off less imports? It wouldn't be. Industrial production in Japan figures came out this week, down 10% year on year. Rail freight in the US has been falling for a couple of years. Steel production has been falling. All of this goes to show that our real economy continues to suffer under the weight of too much debt and silly policy that is only making the problem worse by the day. And the reality is, as unsettling as it is, as much as we'd love to be able to stand here and go, things are really getting better, dealing with the problems that we face is going to be very difficult. As I said earlier, the government deficit in the US was $1.1 trillion last year. Now, the IMF did some analysis that suggested if the government was to take $1 out of the economy, i.e. not go as far into debt, it would have a roughly $1.50 impact on the economy, because obviously there's a multiplier effect. If I have $1 less, it's $1 less that I can spend, it impacts somebody else's income. So if the US government was to wake up tomorrow and go, you know what, this is a dead-end road that we're going down, clearly our economy's not recovering, we need to really just take stock and stop the bleeding as it stands, balancing the budget would lead to roughly a $1.65 trillion reduction in GDP. That's 10% of the US economy. And that is a best case scenario, guys. That doesn't pay back $1 of the debt that we currently owe. it doesn't enact one structural reform to deal with the challenges of the ageing population. Imagine what would happen to unemployment in a situation where GDP dropped 10%. Imagine what would happen to the ability of companies to make profits in an environment when so many more people are likely to be losing their jobs and where there's so much less activity and so much less demand out there because of that. It is an extraordinarily challenging set of circumstances that we face today. That is just the reality. There's nothing any of us as individuals can do to change these macroeconomic forces at play. They have been building for over 50 years. We are going to have to live through the tough times that they are going to bring. And that's fine. It just means that our standards of living are going to fall somewhat, and the smart thing for all of us to do is to focus on preserving our wealth through this incredibly tough time. Doesn't mean we need to panic and prepare for Armageddon like some people are out there are saying. It just means if we want to be prudent and if we want to protect our wealth, we're going to start to look at investments like gold and silver, because they are the one asset that throughout the millennia people have been able to rely on as a store of wealth. They're the only asset that aren't someone else's liability. They're the only asset that you can be absolutely certain of, if 5,000 years teaches you anything, cannot go to zero. And that is why over the last 10 years, more and more people have started buying physical precious metals, and that is why over the next few years, even more people are likely to start to look at protecting their wealth with physical gold and silver. I want to move on now by getting into the actual physical gold market itself. As I said, there's a number of misconceptions that I've often heard in my time in finance about the physical gold market. The two major ones are that gold is an illiquid asset and that it's difficult to trade. And secondly, that because the price has been rising, surely production must have increased massively, which will help push prices down in the future. Let's start by addressing liquidity first. This chart here shows the daily trading volume over in the London bullion markets as they stand today. Over $30 billion a day of gold trades daily over there. To give you some sort of context to that, down the street on the stock exchange, on a good day they might turn over 6 trillion, on a bad day 4 or 5. So the gold market is at least 5 to 6 times more liquid than the blue chip stocks that trade on the Australian Stock Exchange. No one ever worries about the liquidity of that market, and nor should they. The gold market is significantly more liquid than that. It is more liquid than any major government bond market. It is as liquid as any major FX crossing in the world. If you buy a gold bullion, you will most definitely have a market for your metal when it comes time to sell it. It is a very, very highly liquid asset. Anyone that tells you otherwise doesn't know what they're talking about. The second point, as I said, was around production, and this idea that because prices have been rising, surely production will have gone up quite significantly as well. And in the case of things like iron ore, that was certainly true. Over the last 10 or 12 years, global production of iron ore nearly tripled. When it comes to gold though, all the easy gold has been found. 100 years ago, you could mine nearly 20 grams a ton of the stuff in South Africa, in California, and in Australia. Wind the clock forward to 10 years ago, and you could only get about 2 grams a ton. Today, the top 5 gold mining companies are lucky to mine 1.3 to 1.4 grams a ton when they go and try and bring the stuff out of the ground. It is exceptionally difficult to find. It is not easy to increase production. And what that has led to is an incredibly stable production profile for physical gold. You can actually see that for the first 8 years of the gold bull market, the amount of gold that we were producing was actually falling. It doesn't matter that prices were going up by 100, 200, 300%. Gold companies can't just turn on a tap and start producing more of the stuff. And even though production has risen somewhat in the last couple of years, there are no respected forecasts that would suggest gold production or gold mining production in any given year is going to go much higher than 3,000 tonnes. So anybody that tells you that production is going to increase massively as a result of increasing prices is simply not accurate. Production cannot respond in any meaningful way to increased demand. So the only thing that can change is prices will rise. That's what's happened over the last 10 years. That is what's likely to continue to happen going forward. And these production characteristics are ultimately what leads, in many ways, to why gold is not a commodity. And I want to address that from 2 angles. I want to start by looking at the fact gold isn't a commodity in the way it behaves as an investment asset, and then I guess a little bit philosophically on what commodities are for, and what gold is for. Let's start by looking at the correlation of gold and of commodities to the stock market. Obviously, for anyone who's sort of new to this stuff, correlation basically measures if one asset is moving in a certain direction, how likely is another asset to move in the same direction that the original one is. Now, obviously, if you're looking to create a diversified portfolio of investments, if one of your assets is falling, ideally the other asset's going up to offset that loss. So in the case of a stock market, when the stock market is falling, investing in commodities is not going to help you at all because they are positively correlated to the stock market. So if stock markets are collapsing, if history is any guide, commodities are going to fall quite significantly as well. Gold, on the other hand, is negatively correlated. So again, using history as our guide, when stock markets collapse or fall significantly, we can expect gold prices to rise, obviously helping to offset those losses in the stock market and creating a better result for us with our overall wealth. If we were to look at something like volatility, we would see the same thing. Gold is a volatile asset. When people say it's just going to go up in a straight line, very clearly they aren't accurate. We've all probably witnessed that. Anyone who's an investor in gold right now knows that prices can move, and they do move south, and corrections of 10, 15, 20% are not necessarily unexpected. But neither are losses of that in the share market. Losses like that in the share market are very common. In 2007, the ASX dropped 50%. Gold is most definitely not as volatile as other commodities as well. So it's very different in that case. But most importantly, let's have a look at what the performance of gold was in markets where commodities got absolutely smashed. 1814 to 1830, commodity markets dropped by 50%. The price of gold doubled. 1864 to 1897, price of commodities fell by 65%. Price of gold went up by 40%. The Great Depression, commodity prices fell by 30%, whereas the price of gold went up by 44%. And even during the GFC, the calendar year of 2008, commodity prices fell by 40%, yet the US dollar price of gold went up by 4%. In Australian dollars, it went up significantly more. So this is not to say that commodities are bad investments. There are times where commodities are great investments. But anybody that says buying gold isn't necessary because you can just buy a basket of commodities instead, again, they do not know what they're talking about. Very clearly, gold is a very different asset to a basket of commodities. And the reason for that is because gold is not a commodity. And to help understand why, it pays to think, why do commodities themselves have value? Why is oil valuable? Why is wheat valuable? Why is copper valuable? Well, they're valuable because we can use them. We consume them. We use oil to fuel a car or to make plastics. We use wheat to make a bread roll. We use copper for copper wiring for 1,000 other industrial applications that makes copper such a wonderful industrial commodity. Gold is very, very, very different. All the gold that has been mined throughout the course of human history, going back to before the time of the pharaohs, still exists in stockpiles today. It's either in a gold bar, a gold coin, or in some kind of jewelry. It is all still sitting there. It can all be brought to the market, provided both the buyer and the seller are happy with the price. And we have stored it for thousands of years because that has ultimately been its function in our society. It's been the one asset we use as our store and as our measurement of value. And what that leads to with gold is a very, very unique and a very high stock-to-flow ratio. Now, for anyone that's never seen or understood the concept of a stock-to-flow ratio, basically what it means is the amount of existing supplies divided by the amount of annual production. So if you had 100 tennis balls in a tennis ball factory and you were going to make 10 a year, your stock-to-flow ratio would be 10. Now, understandably, for pretty much every other commodity out there in the world except silver, this ratio is below 1 because the only reason we produce it is so that we can consume it almost immediately. Yes, we keep wheat in a silo. Yes, we have oil in pipelines, but that's just moving it to the end user so that it can be consumed straight away. Hence, the stock-to-flow ratios for pretty much every other commodity in the world are below 1. Conversely, for precious metals, because we've just been adding to our existing stockpile every year for thousands of years, our existing stockpile is absolutely huge relative to the amount that we produce in any one year. So even if those 2,800 tonnes that we produce, which I touched on a couple of minutes ago, even if for whatever reason we could magically double the amount that we produce, and we can't, it would still only add 2.5 to 3% to the existing stockpile of gold that we have in the world. So when people say, oh, gold was money because it was scarce, that's only half true. It's not just the scarcity of gold that gives it its value, it's the stability of the overall supply of gold. And when you think about it, that ultimately leads to why gold is a monetary asset, why we've used gold as money, because it is the most stable form of money we've ever been able to find. And it is certainly a lot more appropriate than the paper money that we use in our pockets today and that we keep in our bank accounts, unless you're a Cypriot, because you might not have any money left in your bank account. Gold has been used as money for thousands of years for one simple reason only. It best meets all of the attributes of a sound money system. Paper money meets the first 5 definitions fine. It does work as a medium of exchange. It is portable, it is durable, it is divisible, and it is fungible. But paper money over the long run has proved to be a complete and utter failure as a store of value, which has made it a pretty useless measure of value as well. If you think about the importance of money in our society, it exists so that we can measure value. No different to how a metre measures length, or a kilo measures weight, or a litre measures volume. We've been comfortable using those measurements for hundreds, if not thousands of years, because they've been static. They've never changed. How many of us in the building industry would be comfortable using a metre if one year it was 100 centimetres, the next year it was 105, the next year it was 97? We'd find something else because it would be practically useless to us. Money is exactly the same. And that's why, historically, we've used gold as money because it has been the most stable form of it. And every single attempt to move away from it has ended in some kind of economic calamity. History is absolutely clear on this. There's not been one major society that has ever prospered in the long run under anything other than a gold standard. Absolutely not one. The British, the Dutch, the Romans, the Byzantines, the Egyptians, even the Americans up until 1971 effectively, they were all operating under a gold standard because it was the best form of money, it was the most sensible thing to use, and absolutely switching to paper money led to some kind of serious problem in the future. This was exceptionally well understood by yesterday's smart money, the people that were well in the know and well connected. JP Morgan, the guy who the bank is still running in his name, was so wealthy he pretty much bailed out the US government back in early last century. He said, gold is money, everything else is credit. Voltaire, fiat money eventually returns to its intrinsic value, 0. Alan Greenspan, the Alan Greenspan, I'm sure everyone in this room has heard of him. In the absence of the gold standard, there is no way to protect your savings from confiscation through inflation. Winston Churchill, all previous attempts to base money solely on government edicts or fiat have ended in inflationary panic and disaster. And my personal favourite, betting against gold is the same as betting on the government. And he who bets on government bets against 6,000 years of recorded human history. All of these people implicitly understood, because they had read their history books, that using gold as a monetary standard made perfect sense and it worked, and that every single time we tried to move away from it, we ended up causing huge problems for ourselves that were only resolved with pretty serious market crashes and a move back towards some kind of gold standard. They knew that there had been over 3,500 attempts to base money on paper, to move away from a gold standard. Zimbabwe, Weimar Germany, the Chinese, Bolivia, those are just 4 examples that I've put up there, but there have been over 3,500 attempts throughout the course of human history, and each and every single one of them has either failed or is failing today as we speak. As again, I'll bring your attention back to what happened in Japan just an hour ago. This is important for us to understand because in August 15 of 1971, when Richard Nixon closed the window, he really did try experiment number, or he began the world on experiment number 3,501. And it is going like all of its previous cousins did. It is heading towards 0. We have printed so much money, we are continuing to print so much money, that in the last 40 years, the value of the US dollar has dropped by well over 90%. Now think about it, guys. If I had a pen in my hand and I said I'm going to drop it and it's not going to touch the ground, who here would believe me? Nobody, right? Common sense tells us that gravity exists. I'm not going to bother to do it, but if I did, it would hit the ground. And if I stood here and tried it 3,500 times, the same result would occur every single time. Like I said earlier in the presentation, common sense tells us that printing money doesn't work. We all know it implicitly. We know we have to get up and go to work to be able to create value. If we could print money, we'd have found a way to do it in the past, and we'd probably all be doing it rather than going to our offices tomorrow. But we can't do it, and this current version of it is going to end in exactly the same way that all the other ones did. We're going to end up having to go back to some kind of gold standard, and therefore owning gold is basically the same as owning money in this environment. And saving money, when you consider all the risks that are out there, is a pretty good idea. And if you do it, if you decide, you know what, I really do need some bullion in my portfolio, then you're going to be joining today's smart money. John Paulson, legendary hedge fund manager who made billions throughout the GFC. He heard what mainstream economists were saying, he heard what central bankers were saying, he heard what politicians were saying. Back before the GFC, they were saying everything was going to be fine. There was going to be no housing crash, equity markets were going to continue to go up, unemployment wouldn't rise, you name it. He heard all that, he knew it was nonsense, and he bet against it. And he made billions for himself and for his clients. Today, he's got 44% of his money and his clients' money invested in precious metals. Mark Farber has been a very, very successful macro investor for the course of 3 or 4 decades. He is recommending people hold 25% of their wealth in physical precious metals in this environment. And Ron Paul, a guy who's been in the United States Congress for over 3 decades, a guy who was connected both in Washington as well as very, very clearly understanding what was going on in Wall Street, has gone and put 64% of his wealth in gold and gold-related investments, according to certain reports. These aren't doomsdayers, guys. These aren't people preparing for the apocalypse or worried about everything that's going on. They're just very, very prudent allocators of capital who want to preserve their and their family's wealth, and they understand that in an environment like this, you could do a lot worse than putting a portion of your money into precious metals. And it's not just them. The Chinese central bank is importing over 900 tons of gold a year. That's 1/3 of total global gold production. Other emerging market banks, Russia, India, Brazil, in the past, they all just used to keep their money in US dollars and in US government debt. But they don't want any of it anymore because they understand that it's just being printed into oblivion. So they're buying gold instead. Who here heard the news about Germany wanting to bring its gold back? Now, does anyone in the room think the Germans are stupid when it comes to money? No one, right? So think about it. If gold was a bubble and you've got all your gold in New York and you trust the financial system and you think everything's just fine, why wouldn't you just sell your gold in New York and take the money? Why would you go to all the hassle and all the cost of moving all of your physical bullion back across the Atlantic or the Pacific, I forget which sea's which, into a vault in Frankfurt if you thought gold was going to become less valuable in the coming years? It wouldn't make any sense. Very clearly, they are doing it because they see that gold is going to continue to go up in value throughout the course of the next decade. Endowment funds, family offices, pension funds, they are all doing the same thing. They're all protecting their wealth with physical precious metals. And that pretty much leads me to the last 2 sections of the presentation, which is why gold's not a bubble today and the sort of things we can do next. And I know that this is pretty appropriate right now with the volatility we've seen in prices over the last couple of days alone, but even over the last year, year and a half, we've seen what is, in the context of the last 12 years, a fairly regular correction of 20-odd% in precious metal prices. But I understand that when prices fall $100, $200 over the course of the year, people start going, maybe I've got it wrong. Maybe gold is a bubble. Maybe it's time to sell and to move on to other assets. Now, I hope you don't mind, but before I deal specifically with why gold is not a bubble, I want to show you guys a couple of stories around my time with bubbles, the NASDAQ bubble to start with, and then the US housing bubble, to help give you guys some context to what asset bubbles really do look like, and why the front pages of the news are really not going to help you when it comes to deciding what to do with your investment portfolio. Back in 2000, I was fortunate enough to be working for a stockbroking firm. And at the time, things were going absolutely crazy. People were bidding up technology shares like you wouldn't believe. And for a very, very brief history lesson, for the 12 years from the early 80s to early 90s, the NASDAQ was going up at about 11% per annum, which was about roughly in line with broader stock markets at the time. But in the last 5 years of the NASDAQ boom and bubble, prices went up by over 42% per annum. Compound those kind of returns over 5 years, and you're talking a 500% return on your money. And it led to absolutely crazy speculation. One day, at about 10 minutes before the market opened, this regular punter of ours, and they were punters, came in. His name was Graham. He was a lovely bloke, and he said to me, "Jordan, I need to get through to the market. I need to get through. There's a stock I want to buy. It's going to make a big announcement. This thing's going to fly." I said, "Graham, go for your life, mate. Pick up the phone and try and get through to our trading desk." And he just couldn't get through because there were so many people trying to buy these shares that basically the phones were just off the hook. There was no way of getting through at all. He was on hold for 40 minutes, and he kept going to me, "Jordan, I need to get through." And there was nothing I could do to help him. So I said, "Mate, you're going to have to wait." Anyway, eventually, 10:30 in the morning, he gets through to our trading desk. And the stock that he wanted to buy, I'll never forget, his face just went absolutely white. The stock that he wanted to buy had opened that morning at 6 cents. 30 minutes later at 10:30, it was trading at 24 cents. Absolutely no announcement. The company had no sales, no profitability. It was a bit of a shell company with a wild dream. But it had gone up over 400% in the space of 30 minutes based purely off rampant speculation. What's even more incredible about it is he still bought it at 24 cents and he sold it the next day at 36. He actually still managed to make money because at the top of a bubble, everybody is buying absolutely irrespective of risk, irrespective of understanding the potential for return and loss. They don't care about the fundamentals. They just think you're going to keep making money no matter what. Gold is absolutely not like that today. If anything, people are nervous. They're wanting to sell their metal, not buy it, and absolutely not care if they've got 100% of their portfolio in it. What happened with the NASDAQ led, for me personally, to what's the second story here, which was the bubble in US housing. I was pretty confused when the NASDAQ bubble burst because all of the front pages were saying that that was the way forward and that this time it was different and that the NASDAQ would never burst. Of course it did, and we all moved on. And what it led to for me was a very, very interesting article that I read by a fantastic analyst, a guy by the name of James Puplava, which was all about the unfolding global debt crisis that we were facing. This was back in 2002, way before we'd ever heard of things like subprime or GFC or anything like that. And it led to both myself and a very good friend of mine starting a precious metal mining fund, which Janie mentioned earlier. It was very obvious that precious metals were hugely undervalued back then and that there was massive risk in equities and in property and the like. And in August of 2004, we were invited to fly to Hong Kong to see my colleague who I'd started the fund with, to see his very, very wealthy uncle, who, I don't know the exact figures, but the figure that I was told was that he had made roughly $250 million investing in US real estate, which, again, if you look here, for 15 years was tracking along at about 4.6%, broadly in line with how much people's incomes were rising, not too much higher than the inflation rate, but then, of course, exploded into this huge bubble where it started rising at over 15% per annum. And when you consider the amount of leverage people were using to get into real estate, they were making absolutely astronomical returns for many years. And we went to this presentation in August of 2004 and essentially said a few things. We said, look, there's huge risk in the Dow, in US equities, and they're probably due a pretty serious correction. There is very clearly a risk in US housing. It's had an incredible run. You've done really, really well to date, but maybe you should just look at diversifying your portfolio with maybe $5 to $10 million in physical gold and silver. They're really, really undervalued historically, and they're likely to go much higher in the coming years. But again, at the top of a bubble, nobody wants to sell. This guy actually wanted to leverage more to get into the next development, to buy his next 100 houses, because that's what people think at the top of a bubble. They think there's no way you can lose money, and so they just want to get more leverage and get more exposure to it. Gold is nothing like that today. And as I say, what you see on the front pages of the newspaper are absolutely not going to help you. This chart, this news cover was from August of 1979, and for anyone that can't read at the back, it says the death of equities, how inflation is destroying the stock market. Now in 1979, the US was pretty much coming to the end of 10 years of pretty tough economic times. They had basically what we all know now as the stagflationary 1970s. People had lost well over 60% of their wealth in the stock market at the time over the course of the previous decade. So people were absolutely over stocks. They didn't want to own them. They were really, really, really negative. Nobody wanted to buy stocks. And so the supposed smart money was saying, the stock market's dead, don't put your money in. On the flip side, that second article, which is probably definitely difficult to read for people at the back, suggested that companies should index their bonds to oil and to gold. So because inflation was so high back in the late 1970s, nobody really wanted to lend money into the fixed income market. If you think about it, that makes sense. If you say to me, Jordan, can I borrow $1 million and I'm only going to pay you 6%? I'm going to say, well, hang on, inflation's 6% this year, it might be 7% the year after, 8%, 9% following on. I'm going to end up losing money. The yearly income you pay me is not going to be much use to me, and 10 years from now when you repay me my principal, it's going to be absolutely worthless. So nobody wanted to lend to the fixed income market. So the supposed solution to this was, well, if you offer to repay people an amount that goes up with the gold price, then people will be more willing to lend to you. That was the logic at the time. That was what the smart money was telling people to do at the time. Of course, within 5 months of this being the front page, gold peaked and began a 20-year bear market where it lost nearly 75% of its value, and equities began the biggest bull market of the 21st century. The front page of the news was the absolute worst place to go to get your investment advice. And let's look at what the front pages are saying today. Sydney Morning Herald 3 weeks ago, time to hop into stocks. They're already down 3% since that came out. Meanwhile, over on Bloomberg, 3 headlines in a row. Is this the end of gold's bull run? Is this the end of the 12-year bull market for gold? And is the gold bull market dead? Listening to the front pages is fundamentally the wrong place to go if you want to get sound investment ideas for what to do with your portfolio. And the quantitative data, when we look at gold and whether gold is a bubble or not, absolutely backs this up. Let's have a look at gold versus the Dow Jones. This ratio measures the value of an ounce of gold divided by the value of the Dow Jones, which is a representation of the 30 largest stocks in the US. And as you can imagine, in periods of real economic prosperity and where people feel really positive about the future, no one wants to own this boring old yellow metal that just sits in a vault. They want to own stocks because those stocks are going to grow and they're going to buy out businesses and they're going to pay dividends. So what you see is this huge explosion in people buying stocks and people selling gold. And so you see this ratio go up quite high. Now before the Great Depression hit, that ratio went all the way to just about 20. But when the Great Depression did hit and people went, my God, we really are facing this difficult economic period, I just want to save, I want to hold on to what I've got, then nobody wanted to own stocks and everybody wanted to own gold. And the ratio crashed all the way down to 1. Then it trickled along for the better part of the next 25 years until after the Second World War. And then again, we see this huge baby boomer period of prosperity and everybody feels bullish and everybody starts buying stocks. And the ratio this time goes all the way up to 30. But then we do hit the stagflationary 1970s. And pretty tough economic times, stocks do terribly. Everybody wants the safety and the security of investing in physical precious metals. And what happens? The ratio comes all the way back down to 1 as well. This is exactly when the smart money was telling you to buy gold and stay out of equities. The very, very worst time possible, because over the next 20 years, gold does absolutely terribly, while equities go up by the largest amount they have ever. And the ratio goes to over 40 to 1 at the turn of the century. Since then, we've very clearly been in an equity bear market and a gold bull market. There's no doubting that. So gold's not as cheap, very clearly, as what it was 10 years ago. But that ratio has always historically gone to 1. The Dow is over 14,000 today, and gold's less than 1,600. So if history's any guide, stock prices are going considerably lower, or gold prices are going a lot higher in the following few years. This next chart shows gold and gold mining companies as a percentage of total global financial assets. And at every other previous major gold bull market top, the number has been between 20 and 30%. Before the roaring 1920s, at the end of the Great Depression, at the end of the Second World War, and at the end of the stagflationary 1970s, that is where that ratio has gone to. Today, there's over $225 trillion of financial assets out there in the world. And it's growing by the truckload every day with all this money that's being printed. the value of all the gold that exists in the world at today's market price and the value of all the mining companies, the major mining companies that pull this stuff out of the ground, is considerably less than $10 trillion, less than 4%. So if history is any guide, this ratio is going to go much higher, and that can only be done with gold prices going significantly higher. Probably the most important one, gold versus inflation. Now, if you listen to a more mainstream economist using traditional CPI figures, they will say that the inflation-adjusted gold price is only $2,500 today, there or thereabouts. The whole purpose of doing an inflation adjustment is that you do an apples with apples comparison over the course of 10, 20 or 30 years. In the last 30 years, there have been 30 major changes to the way CPI is calculated, and each and every one of them has lowered what the CPI calculation would otherwise be. So that measure is absolutely meaningless now. If we actually do a proper apples with apples comparison, the price would be well north of $8,000 today. All of these things go to show that gold is most definitely not a bubble at today's prices. But to give you guys a guide of what a bubble might look like, today as we stand here, these are the sorts of figures we'd be talking about. If gold goes up 25 times like it did in the last bull market, you'd be talking a price of about $6,600. As I say, that real inflation adjustment figure would be closer to 9,000. Assuming equities don't fall, which everyone's telling you they won't, a Dow gold ratio of 1 to 1 would put the gold price at $14,000. And if the value of the United States government's gold was to merely back the US money supply, as it has in the past, then the gold price would have to go to $10,000 in today's value. If we took an average of all of these guys, we'd be talking about $10,000 in today's value. These are not necessarily price predictions, but they give us all a framework to understand why gold is most certainly not overvalued in today's prices. But the most important thing to understand really when it comes to gold and ultimately where prices are going to go is the fact, as I said, that gold is money. So it competes with this paper money that we've got in our pockets and that we keep in our bank accounts. The only way to really end a bull market in precious metals is to make the interest rate that we can earn on that paper money significantly higher than the rate of inflation. You need to raise the opportunity cost of investing in gold. Think about Cyprus again for the minute. You're only getting 1% if you leave your money in a European bank, and if push comes to shove, they might just take it from you. What's the incentive of keeping your money in a bank, earning next to nothing, earning a negative rate of return, versus holding physical precious metals, which you can be pretty sure in an environment like this are going to keep appreciating in value? That is how, back in the 1980s, Paul Volcker and the Fed back then actually did kill off the last gold bull market at $850. They raised the federal funds rate to 19%. Imagine what 19% interest rates would do to our economy today. Back then, when the US was the world's biggest creditor, you could get 16% lending them money for 10 years. You didn't even have to take risk with the equity market back then. You could just give your money to the US government, say, here you go, Uncle Sam, please look after me, and they would pay you 16% a year back then for 10 years. That's what killed a gold bull market, and fair enough. Why hold this asset that's not paying you any yield when you could get such incredible returns back then? But wind the clock forward to today, and the federal funds rate's 0.25%. That 10-year bond yield's out of date now. It dropped even further overnight. It's lower than 1.8% today. Both of those rates are less than the rate of inflation. So you are basically a guaranteed loser if you put your money in a bank account or give your money to the US government. You take credit risk, you take inflation risk, you take all of these other things that you don't take if you get precious metals. The way that we have our financial system structured today is absolutely no way to kill a gold bull market. And this is not just theoretical stuff. 40 years of history shows it very clearly. In environments where the real interest rate has been 2% or higher, then gold and silver have performed very poorly because everyone starts going, okay, I don't want to hold this metal that's not paying me an income. I'll put it in a bank and I'll start getting some income off it. But environments where the real interest rate is 2% or below, and they are negative all around the developed world today, then more and more people start saying, I do not want to leave my money in a bank. I am much smarter storing my wealth in precious metals where I have a very, very strong likelihood that I'm going to get capital appreciation of 10, 12, 13% per annum on average. And the reality is, as much as we're being told that our economies are recovering and that soon interest rates are going to normalise There's absolutely no way as a society that we can ever afford for interest rates to go back to any kind of normal level. As I said earlier in tonight's presentation, US government debt is currently $16.7 trillion, and they take in tax revenue of about $2.4 trillion a year. The borrowing rate on their debt today is 2.2%, which means they're paying about $359 billion a year just in interest on the national debt. That's 16% of tax revenue today. Not a huge amount, it's certainly significant, but it's not really hurting the budget as it stands. By the end of 2017 though, the US is projected to owe $22.6 trillion. And according to their own statistics, they're going to take in roughly $3.17 trillion in tax revenue. So if interest rates were just to go back to 6.5%, forget the 19% that they had to go to in the early 80s, then the interest on the national debt alone would account for 46% of the money that Washington takes in. How on earth do you pay for schools in that environment? How do you pay for infrastructure? How do you pay for a military? How do you afford Social Security, Medicare and Medicaid, all of those things that are already consuming more than 100% of tax revenue? There's absolutely no way you can do that. So, very clearly, we cannot afford for interest rates to go higher, and the only way we can hope to keep them low is by continuing to give the central banks the right to print as much money as they want to push those interest rates down. And ultimately, an environment where nominal interest rates don't rise and central banks print money is about the sweet spot for precious metals. And that is exactly why everyone should be looking at holding a portion of their wealth in physical gold to protect their portfolio and to protect their standard of living through these times. I want to end by talking about how much is enough. Now, obviously, we're not licensed to give financial advice, so we can't tell you what to do. But what I can do is give you a very, very real illustration of what I'm doing right now for my dad. My dad's recently retired, and he's just inherited about $300,000. Now, essentially, there are two ways that I see things going. If central bankers and politicians and mainstream economists, all of whom never saw the GFC coming, and all of whom keep telling us everything is going to be fine, if they turn out to be accurate, I don't believe they will, but if they did, then a diversified mix of more traditional assets would be expected to compound at about 7% a year, which means over the course of a decade, you'd basically double your money. And if gold is indeed a bubble today, and it does correct like it did between 1980 and 2000, then if history's any guide, it's going to fall by 75%. But if history tells us anything, if the Great Depression should teach us something, if the stagflationary 1970s should teach us anything, if what we've seen 3,500 times throughout the course of human history means anything, then traditional investments could easily fall 80-odd% from where they are today. And precious metal prices could very, very easily rise another 500 to 600% from here. So as I've said to Dad, look, there's two things we can do. We can hope for the best and put all our money into traditional assets, or we can, you know what, take a bit of insurance. Let's be appropriate. Let's take some risk off the table and hold some physical precious metals in our portfolio. So I've put 25% of his money, or 75 grand, into physical gold. Basically, what I've explained to him is there are pretty much four outcomes that could happen from here, if this is any guide. If he puts all his money, if he puts all his money in traditional assets and everything does work out fine, then that $300,000 portfolio is going to double over the course of the next 10 years, and he'll end up with 600 grand. That'd be great, but that's not how Dad's money's positioned. He's got 25% of his money in gold. His portfolio in that kind of environment, good-looking man, by the way, he's going to end up with about $468,000. So he's still going to make money. He's still going to participate in the upside that would be there. He's basically going to end up with $8 for every $10 that his neighbours and his friends and his family and other people that don't invest in precious metals would end up with. But if history does tell us something, if now is a good time to be taking some risk off the table and investing in some precious metals, then let's go back to that first guy who put all his chips into traditional assets. His portfolio's gone from 300 grand to $60,000. That is a pretty drastic reduction in your standard of living. That's a guy that's got to explain to his family why you're not going on many holidays anymore and why the good times are over. But Dad, because he has put 25% of his money into precious metals, he's still smiling because his portfolio would still be worth over $400,000 in that case, because that 25% insurance policy has paid off so significantly that his overall wealth has not only been protected, but has been enhanced. Now remember in the first example I said Dad would end up with $8 for every 10 that his neighbours have if he takes insurance. In this case, he ends up with $8 for every one that his neighbours have. That to me is a pretty good trade-off when you consider the risks that we face in the economy today and the underlying reasons as for why people should be investing in metals. So I can't tell you that that example is appropriate for you. I obviously don't understand or know anyone's particular circumstances here, but what I would highly encourage everyone to do is really take stock of where their financial position is, really take stock of where their money is invested, what kind of fees they're paying, what they're really doing with their money, and make sure that they're appropriately positioned for what are going to be some very, very difficult times. Before I finish and welcome Kerry back to the stage, there's obviously a number of companies, including ABC Bullion, that you can speak to really help maximise your position in this time. We'd obviously love to see you down at our showroom and down at our offices on Pitt Street. We are Australia's oldest, largest independent bullion dealer, so we're very happy to help you. We have a full range of products that can help you out. But for some of you that may be a little bit younger and maybe starting out in your investment careers, or perhaps some of you that are a little bit older but might like to start putting some money aside for grandkids and the like, there's an absolutely fantastic product out there that a sister company of ours has just started called First Gold. It basically works as an everyday savings account where you can direct debit money into an account, and instead of saving in dollars, like with a CommBank account or an ANZ account, for example, you can actually save in grams or ounces of gold and silver. Really highly recommend you go and see the guys outside and talk to them about that. And of course, for anyone else that might have a larger balance of investment assets or indeed superannuation, everyone obviously in the room is forced to pay money into super, then we do have a relationship with LJ Financial. They can help you out in terms of maximising your super and making sure that that money is invested appropriately as well. So thank you very much for your time tonight. I appreciate you staying and listening, and welcome Kerry back to the stage.
Questions from the floor? Okay, Hannah, right at the front here. I'm going to make this, if you can make your questions nice and succinct, so we can get through, just in the second row there, Hannah. Thank you.
Most economists, from what I can see from the internet, recommending silver to be much more effective for the future. For the first, it's undervalued compared to gold, and secondly, it has got a much higher industrial value,
Sure.
whereby gold hasn't.
Sure.
Second question, if times turn really bad, what I do with a physical bullion, and who can buy it? I can only, I've got only, it's undervalued if someone buys it for me in order to buy some food or other things.
Sure.
Thank you.
So the question I'm taking it is silver likely to be a better investment than gold?
Yes.
Right.
Yes.
Yeah, look, I think from the potential for prices to increase by a larger percentage, absolutely, I believe silver will outperform gold, probably by a relatively significant factor as well. The main reason for that is that if you think about an ounce of gold, you're paying basically $1,600 right now. An ounce of silver, you're paying roughly $30. So as more and more people look to move money into precious metals, they're going to find it a lot easier to afford an ounce of silver than they are an ounce of gold. So I absolutely do agree that economists and people that understand the precious metal space, I do agree that silver will outperform gold. And look, it's certainly what we're seeing in our showrooms. We sell an incredible volume of physical silver because a lot of people have obviously cottoned onto that idea. But it's very important for anyone to understand that silver is a significantly more volatile metal than gold. So it depends what you're looking to do with your money. If you're saying, I've got a portion of money that I want to put in precious metals for 10 years and I don't care about the volatility, then logic would suggest silver would be a better investment than gold. But if you need your money on a shorter term basis, then gold's a safer way of investing in the precious metal space. As to your argument about if things get really bad and what value would your gold have in that environment, am I right to sort of interpret you're sort of thinking the kind of financial system's broken down and the banks are closed? Well, put it this way, in that environment, I'd much rather have a silver coin in my pocket than shares of BHP, because shares or investments in traditional assets will have absolutely no value. A physical coin, you'd still be able to trade it for, you know, cans of food, lighters, fuel, you name it. So it's absolutely not a reason to not want to diversify your portfolio into physical metals. But my personal belief is that things are not going to get that bad. I just think we're going to go through a reset of the financial system. Gold is moving back towards the heart of it, and I definitely want to have a portion of my portfolio in it while that's happening.
Yeah, and I think I'd echo that. You know, it's not Armageddon, it's not the end of the world as we know it, but what Jordan's saying is part of a balanced portfolio. It's always good to have a mixture of different assets. And it's interesting, Jordan spoke about his father and putting some of his assets into physical gold. I actually might put my dad into some physical gold. He watches the gold price every day, and at the moment he's going, it's going down. Yes, Dad, it's okay, don't worry. Gentlemen, to two-thirds of the back of the room with the microphone.
Hi, Jordan. Thanks again for your talk. Just a quick question about the movements in Cyprus and how that has caused a big change in the Bitcoin market, and what your thought is on Bitcoin as compared to precious metals at this point.
Yeah, sure. Look, it's a bit of a tough one. Thanks for that. Only because I can't say that I'm an expert on Bitcoin, but my understanding is that it's a computer-generated currency where there's an algorithm involved which basically increases the supply of Bitcoins, but at a very, very slow rate, roughly kind of like how gold is mined in terms of it being very stable. My understanding is that Bitcoins have gone up quite significantly in value, including since the Cyprus event. And I suspect that they probably will continue to go up. I certainly think for most people though, they'll feel safer investing in a physical metal which is stable in supply rather than in a sort of digital currency that is theoretically stable in supply. I think it's an interesting one though what you say about Cyprus though, because last week we literally had a client ring up, and it's quite important when you think about this in the context of the economy. This client rings up and he said, look guys, I've got $1 million, and because of what's happening in Cyprus, I'm really scared about leaving my money in a bank. And I want to come and buy physical metal from you guys, and I want to store it somewhere. And he was so worried, he wasn't even sure if he wanted to store it with ABC, or even now that we've got custodian vaults, he wasn't even sure that he wanted a private vault. Now think about that from the impact, in terms of the impact that has on the economy. That's $1 million that's now no longer sitting in a bank account, that can be lent to a productive business, which can be used to generate jobs and generate wealth. That $1 million has just come out of the system now, and is literally going to be hidden away until the dust clears. As more and more of that happens, that is an absolute disaster for the economy. What happened in Cyprus, people now, they didn't get up the next day and go, right, I want to go to work and produce and generate wealth. They rang up their bank, they went down to their bank and said, I just want to take my savings and go and put them somewhere where I can trust them. So developments like Cyprus, in the long run, definitely bullish for precious metals. I can't say with as much clarity about what they're going to do for the Bitcoin market though.
Jordan, I'm feeling a bit lonely. Can you come and join me up here?
Sorry.
That way they can see you down the back. There we go. Oh. Gentleman right at the front.
Hi Jordan, great talk, thanks. Just wanted to get your opinion on silver and gold ETFs as opposed to physical bullion.
Ooh.
Look.
Good question. Good question.
Look, as far as I can say, there's nothing wrong with an ETF as a trading vehicle for buying physical gold and physical silver, or any asset from that point of view. Do all ETFs have the gold and have the silver? I am sure they have a legal document that says they have claim to it, but that is very different to actually owning it and physically having it. But literally, Roy, the reality is, a gold or silver ETF is no different to the bank account that you've got with Commonwealth Bank or ANZ Bank. You've got a statement that says you have $10,000 there, or whatever the number happens to be, but you don't actually have that money in the bank. They don't have 10,000 paper bills waiting there for you with your name on them. So is there a problem with ETFs? Not necessarily. Do I feel more comfortable owning physical? Absolutely.
Okay, and if I could just ask everybody, because we've got a lot of questions, one question at a time. Thank you.
Hi. My question is with regards to the global market. what percentage of that global market today is with the precious metals being bought by governments, central banks, pension funds versus private guys like us here?
Yeah, sure. So look, retail investment has definitely picked up quite significantly. Western developed central banks haven't really been in the market buying, but emerging market central banks are most certainly buying. As I said, Russia, India, China, Brazil, they are all out buying in record quantities. So the actual amount, it's quite ironic in that central bankers are saying gold is no longer money, when at the same time the amount of gold that central banks are buying is at levels that we haven't seen since the 1960s. And in terms of institutional buying, the value of gold and precious metal related investments inside of institutional funds management is still less than 1% of their total assets under control. So there's clearly a long way for that market to move, and obviously that can only be done at much higher prices.
Great, thanks. Gentlemen, 2/3 of the way down on the right.
First class lecture, thank you very much. 2 questions, if I'm only allowed one, choose one. The first question is, speak to price discovery on the COMEX and bifurcation of paper and physical prices. And the second is, could you speak to Section 4 of the 59 Reserve Bank of Australia Act and 1933 Rooseveltian confiscation?
The 1959, you refer to the legislation.
Section 4, which is dormant on the books, just needs the Governor General to activate it.
Which basically suggests that all private gold holdings in the country could be nationalised.
Subject to seizure, correct.
Yeah, sure. And obviously segueing into, so obviously in 1933, Roosevelt did pass legislation that basically nationalised all gold holdings in the US. Could it happen here? Look, absolutely it could. No one in this room, no gold analyst can give you a definitive answer on that, because that's going to be a political decision. That's got nothing to do with the gold market specifically. So is there a chance it could happen? Yes, there is, but would that make me not want to own gold because I'm afraid that the government might one day legislate that I have to give it to them? Absolutely not, because it's obviously only going to happen if prices have gone significantly higher.
Thanks, Jordan. Gentleman right at the back.
Hi, Jordan. Look, thank you for the talk today. Very quick question just in regards to, I guess, gold's current price.
Mm-hmm.
And obviously, looking at what's happened in Cyprus recently,
yeah.
I'm just curious as to what your take would be in that recent fall. I mean, my perspective would have been maybe that people in Cyprus and seeing what's happened there and the rest of you are pulling their money out of the banking system, and I would have thought that they would have thrown it into precious metals. Do you feel that it may have gone into the US market instead? And what's your take on the recent move in gold?
As in, they would have moved their funds to the US in terms of into US banks?
Or whatever the case may be, I guess in terms of explaining the drop in
the gold price.
Yeah, gold.
Yeah, sure. Look, obviously, as I said in answer to the earlier question over there, over the next few years, what happened in Cyprus, and that being used as a template for what's probably going to happen around large parts of Europe, Japan, and the US, I have absolutely no doubt that will be bullish for precious metal prices. As for whether or not it should cause prices to skyrocket all of a sudden, obviously it hasn't happened. I don't expect that it necessarily would happen either, but that's the same for all asset markets. I mean, I can remember back in 2007, 2008, when I was in London, we had a chief economist, and the day that the US government came out and said that they were going to nationalise Freddie Mac and Fannie Mae, the idea was that would put a huge bid under the equity market because everyone would feel, okay, now the government is supporting things. Equity markets dropped 20% within a fortnight of that announcement being made. So I don't think it's really a great idea to read too much into 1 day or 2 days market movements. You've got to look at the context of, gold's been going up for 10 years. It's been a pretty smooth run actually right now. I know everyone's seeing these sort of moves of maybe $100 over a few months, and I think that's very volatile. But in percentage terms, it's actually only 7 or 8% moves. It's nothing that should be unexpected in the context of an ongoing bull market.
Gentleman right at the back. I'm trying to get you all.
Yeah, thanks. What would you say your top 3 sources of information online, for example, would be? I mean, have you got any sort of real credible resources of information in terms of websites or?
Yeah, I guess for more sort of traditional news in Australia, I use Macro Business. For other favourite sites would be Zero Hedge, Financial Sense, and probably Prudent Bear. They'd be the 4 that I'd spend my most time on. Definitely not Bloomberg.
Didn't like what they had to say. Gentleman in the green T-shirt.
Yeah, hi. I was wondering if you could talk about the dominance of the U.S. currency dissipating, which is exemplified by the Australian and Chinese currency deal looks to be going forward, like with a direct conversion.
As in the US dollar obviously losing its status as a reserve currency?
Correct.
Yeah, I mean, look, it's a trend that's been in place for the last 10 or 15 years very clearly. You know, the US was the dominant global currency for one reason and one reason only. That's because it was backed by gold. The minute they stopped backing it with gold, they set in place what's essentially been I guess a slow motion train wreck in terms of the US dollar losing its status as a global reserve currency. And I have no doubt that other currencies will compete with that over time. The Chinese will obviously be a pretty key player in that space, and I have absolutely no doubt that in order to do that, the Chinese know very well and very clearly that they're going to need to accumulate a much higher bullion reserve in order to actually have a reserve currency that can compete with the US. So I think it's just another step in an inevitable movement of the dollar losing its role as a reserve currency.
Gentleman at the front.
Hi, Jordan. Thanks for your talk. That was very good.
If you could just put the microphone.
Can you hear me now?
Yeah, I can now.
Yeah. Sorry. Just two quick questions.
Mm-hmm.
The first one is the ratio between silver and gold. We're currently about 57. What number do you think it might drop down to? They've been talking about like 20, 15. Do you have any idea what that might be, or?
So we'll just repeat the question because they couldn't hear it.
Yeah, it's basically a little bit like the question earlier around the ratio between gold and silver. Historically, they've been around the 15 to 20 to 1 mark. Right now, it's closer to 50. So there's an implicit sort of suggestion that silver relative to gold is undervalued, and therefore, if gold keeps going up, surely silver's going to go up even more. As I said in answer to the question earlier, I definitely think that will happen. As to where the sort of the number will stop, I suspect it'll be in the low teens somewhere. But look, I mean, if you think about what happened back in 1980, I think there was like a 1 week trading period where the ratio went to 9. But the main thing really is that most people have no exposure to precious metals. Whether they get it by gold or via silver, I think they're going to be very well served over the coming decade.
No, I really have to limit it to one question. I'm sorry. Alan.
Yeah, very interesting talk. My question is relevant to why is it taking 7 years for the US to return the gold to Germany as they suggested? And relevant to that is the Gotha situation, who are trying to raise a case against the US federal government. In the US, they're trying to collect $500,000 to $1 million to try and force documentation that will perhaps give some answer to that particular question.
As in, you're saying if they've got so much gold, why can't they just ship it back quickly?
Correct. It doesn't take 7 years to build a vault.
You wouldn't have thought so, no. Look, there's two answers. The one and the most obvious one is that the Germans have said they're happy to wait 7 years. The more, I guess, conspiratorial answer is that the gold isn't actually there and therefore it's going to take a long time for them to be able to service it. Either way, I don't really think that it adds much value to the argument of why you should be investing in gold. Whether or not that gold is actually in private hands and not in the central banks where they say it is, it's fundamentally an undervalued asset and people should be buying it. As for Gotha, I appreciate a lot of the work that they do, but a lot of their work is really around, there's obviously manipulation going on. There's manipulation going on in every single market right now. What the Bank of Japan announced 2 hours ago was that they're going to print money to buy bonds and potentially to buy stocks as well. So we just happen to live in an environment where every asset class is manipulated. Gold's no different to that.
Gentleman towards the back.
Hi, Jordan. Great presentation. Just quickly, I think a good website would be King World News as well. Just add it to the list.
No worries.
And my question is, why does the mainstream media use such euphemisms like making a contribution or a savings tax in relation to the Cyprus bailout when it's really just theft?
I tell you what, I'll ring Rupert and ask him. I guess I can't really comment on why the mainstream media is doing it. Obviously, they are doing it. But look, the reality is, what happened in Cyprus is, as I say, it's pretty unfair. It's a disaster for the economy. But it's also a bit of a wake-up call for all of us to go, actually, the money that we all think the money in the bank is actually our money. It's not. The minute we put it in a bank account, we have made a loan to the bank, and we have said to them, you are allowed to go and take risk with our money and invest it. That is the reality. So when those banks go out and make investments, if those investments don't work out, then we're going to lose our money. The reality is, unfortunately, the Cypriots are probably just the first in a long line of countries that are going to learn that lesson over the next decade.
Okay, gentleman at the front here.
Hi, Michael Reddish here. You probably already answered my question. Well, just jokingly, is there any money in Fort Knox? But Eric Sprott has just done a very deep analysis with all the movements of gold, and it's almost definitely a lot of the gold in the gold reserves is paper, not real gold, because it's been leased out and that China's getting a significant amount of real gold.
Yeah, I have absolutely no doubt when you look at the numbers that Sprott's put together that very clearly there is what I suggest or what I believe has happened is that in terms of Fort Knox and other central bank depositories, there's a claim on gold that's meant to be there. That gold has probably been leased out. Who knows where it is right now? And so somebody else probably thinks that they're the ultimate owner of that precious metal, when in fact they're not, or it'll end up in court in terms of who actually really owns the gold. There's no question that there's a whole hell of a lot more paper being traded than there is actually physical around there. Whether it's in Fort Knox or not, I don't have the key.
Janie, did you want to make a comment now or in a little while? Okay. Gentleman just here. Yeah, we're good.
Jordan, I'd just like to get your thoughts on the Aussie dollar. What worries me is Aussie dollar seems to be one of the few AAA safe havens, and the gold price is obviously being affected by the strength of the currency. Have you got thoughts on where you see Aussie dollar going?
Yeah, I do. I think that obviously over the last 10 years, investors in US dollar precious metals have seen price rises of probably on average 15% per annum, whereas in Australia it's only been closer to 10 or 11% because the Australian dollar has appreciated so significantly versus the US. My feeling is that that run is over now. Australia can't afford for our Australian dollar to go much past 110 versus the US. Manufacturing, tourism, all other very important sectors in our economy simply can't afford for our dollar to keep appreciating. And look, as much as we keep being told by Wayne and Julia that everything's absolutely fine down here, interest rates are at 50-year lows in Australia. The last time they were this low was during the GFC, and the Reserve Bank governor, who just got reappointed, said that they'd been cut to that level in response to catastrophic economic conditions. They're back at the same level they are today. Very clearly, all is not well in Oz either. So the argument that the Aussie dollar is going to go much higher, I don't think it'll continue to go much beyond 110 at the worst.
Okay, just to put it in perspective, a couple of things from me, Jordan. This is housekeeping now. Those people that have been lucky enough to get the silver coin, if I could just ask you to come up to the front before you leave so we can get a lovely photograph of you all, hopefully smiling. I'm going to take 3 more questions because we are strict to time. So I'm going to start with the gentleman over here.
Hi, thank you for your talk. Do you see in the future that the physical price and the spot price are going to split, or do you think it's all going to go smooth sailing right now?
Look, I think unquestionably the physical market is going to gain significantly more importance relative to the paper market over the next few years. As I say, probably a little bit in response to the question earlier about ETFs and the like. There's no question that if you really want the wealth protection that gold gives you, as well as the potential for an increase in an asset price, then you really need to own physical. If you just want to trade an investment that you think is going to go up in value, but you're not worried at all about financial risk or any of that other stuff, then staying in paper is probably fine. But I would certainly advocate people go physical.
Gentleman at the front here, he did get his second question in. I've been kind.
Thank you. Gordon, you mentioned that silver is volatile, and obviously it will outperform gold as we've been discussing. So I'm looking at the future of that. Is an investment that we may have to sell later on? Is because you're saying it's volatile that it may drop? I don't know. I'm just trying to get a perspective of that. Why do you think it's volatile? I don't understand that.
Why do I think silver's volatile?
Yeah. Well, if it's going to outperform, and obviously there's more gold. More gold than silver now, and there'll be a greater demand industrial-wise, and I just can't see why silver would go down, or not stay at the level when it reaches it.
Sure. Well, there's 2 questions in there. One is what's going to happen to the price,
It's always two questions. You're like Keith Good at the mining club.
Two questions from the second row.
Yeah.
No, look, there's two things there. What's the price going to do, and how smooth is the rise of that price going to be? As I said earlier in response to a couple of questions, I have next to no doubt, based on where the ratio is today and what's going to happen with demand, that silver will considerably outperform gold over the course of the next 10 years. But history shows us very clearly, and in fact it's largely because it does have such an industrial aspect to it, that the price is going to be much more volatile along the way. So whereas gold might move in ranges of between 10 and 15%, with silver it's going to be more like 35 to 40% up and down at various points in time. So as an investor, if you can stomach the additional volatility, history would suggest you're going to get a higher return. But you've got to be prepared to live with that.
I'm going to take last question, man in the blue shirt, halfway down. Thank you.
Would you comment on the relationship between platinum and gold?
As in the fact that, what would you like to...
do they move
together,
parallel, or is there a fluctuation greatly?
Look, I haven't spent a huge amount of time studying the relationship between platinum and gold specifically, if I'm being perfectly honest. So I can't really say why platinum will tend to outperform gold over a 6-month period and not on the other. Certainly the PGMs, platinum and palladium, have been doing very well over the last year, especially relative to the gold price. I think the important thing to understand with platinum and also with palladium is that, unlike gold, which is actually mined all around the world, the concentration of mine output for those metals is very, very heavily tilted towards South Africa. There's been huge problems in South Africa with industrial unrest over the last year, and that's basically meant a lot of people are really, really worried that there's not going to be any platinum or palladium coming out of the mines, and also the actual demand for platinum is far more tilted towards, industrial applications, catalytic converters for cars and the like. So even though it's a precious metal, it plays a far more sort of industrial role. So I don't really think that the relationship between gold and platinum is hugely relevant unless you're trying to just trade the two and make money on that angle. But the more important thing is to sort of go, well, do I want to be in precious metals at all? And I think the answer to that is yes.
Right, I'm sorry, I can't take any more questions, but I'm just going to remind you, because Hannah's just given me the heads up, don't forget to fill in your feedback form. We've got 3 of these wonderful silver bars to give away, 10 ounces. And if what Jordan's been saying is anything to go by, store it safely in the vaults with Janie's company, and I'm sure you'll see it outperform lots of other things. Ladies and gentlemen, I found what Jordan had to say this evening fascinating. I'm always looking to educate myself about what's going on. We do live in very volatile times. It is essential, in my opinion, that we all stay up to date, and we come to seminars like this one that ABC Bullion have done, because it is important that we keep understanding what's going on during extremely volatile markets. I'd like to say my personal thanks to Jordan before I invite Janie to come back to the stage, but please, ladies and gentlemen, show your appreciation to Jordan Eliseo.
Thank you. Thanks, mate.
And if I could just ask you to also just take a moment to welcome Janie, who's been kind enough to put this seminar on for all of you this evening. I think it's been great. Janie, thank you so much. The floor is yours.
Well, thank you very much, everyone, for coming tonight. I have to say, I've been working at ABC Bullion for over 20 years. Every day is completely different. And how lucky are we to have Jordan Eliseo as our new in-house economist. That was an amazing talk tonight. One other thing that I didn't say before that was quite remiss of me, we have had a massive couple of weeks trading. And the staff at ABC have been absolutely amazing. They've been working endless hours and to string together a day like we've had today and then pull together and turn out tonight as well is absolutely phenomenal. So I'd just like to thank everybody in the ABC team for just being so professional and amazing. Thank you all for coming tonight. We're all going to be in the foyer afterwards. If you've got any questions or like to come up and chat to any of us, we'll all be there. Thank you very much again.